Welcome to the debate. The financial landscape for retirees is, well, it's fundamentally changing. The traditional 60/40 stock bond portfolio is clearly under immense pressure, and we're seeing institutional investors radically shifting their strategies. So the core question facing investors today really is this. Should retirees prioritize proactive growth strategies, using alternative assets to combat longevity and inflation risk? Or should they focus primarily on downside protection and liquidity preservation against that really devastating risk of early retirement market downturns? I take the position that sophisticated growth and diversification via alternatives are pretty essential for long-term security.
And I come at it from a slightly different angle. While recognizing that everyone, of course, needs long-term growth, the immediate, I'd say disproportionate threat posed by sequence of returns risk demands a singular focus on caution and capital protection, especially, in that critical window right around retirement.
Right, but the structural evidence suggesting we move beyond the 60/40 is, it's overwhelming. Public equity valuations are at historically elevated levels. When we look at the S&P 500 CAPE ratio, that's a long-term measure of market valuation, it's nearing 36. History tells us that when valuations are this high, subsequent annualized returns over the next few years are projected to be, well, frankly, quite low, only around 3.0%. Relying on public markets for future returns right now is simply inefficient and risky. Large endowments and sophisticated investors, they recognize this. They're allocating maybe half their capital to public equities, but significantly moving, 30 to 40% into things like private credit, real estate, and other alternatives.
Okay, I agree that the negative equity risk premium is concerning. I absolutely do. However, for an individual retiree, the danger isn't really the average return over 30 years. It's surviving the first 10. There's research by Wade Pfau. It's quite compelling, showing that the returns you receive just before and just after retirement can explain a staggering 77% of your maximum sustainable withdrawal rate. So if a retiree encounters a major downturn early, like that negative 17% drop the 60/40 saw back in 2022, they are forced to sell assets at a loss. If we can't survive the first 5 years because we're forced sellers, the 30-year growth plan is frankly irrelevant. Protection strategies focused on minimizing bad volatility, the downside, are paramount.
But look, if your only focus is mitigating sequence risk, you are effectively guaranteeing failure down the road due to longevity and inflation risk. You are sacrificing necessary long-term growth. And it's not just equities. Public credit spreads are tight, mirroring the low-risk premia in public equity. So if you want true inflation buffering and enhanced returns, you must move beyond public assets toward alternatives like infrastructure, real estate, private credit. We see data from firms like Apollo showing that a 50-30-20 model, where 20% of the portfolio shifts into private assets, actually shows enhanced annualized returns. It moves from about 7.6% to 8.1%, and importantly, with a lower overall standard deviation. The large institutional investors, they've already made this move precisely because the current public market outlook is so inefficient.
That 50-30-20 model, it is compelling on paper, especially for a major endowment with unlimited time horizons. But we have to address the cost: illiquidity. Private equity and infrastructure, they often use closed-end funds with lockups spanning 10 or even more years. Retirees need liquidity to manage early retirement withdrawals, particularly when markets are depressed. That illiquidity is precisely the opposite of what's required to implement, say, the necessary cash buffer strategy that firms like Schwab talk about to avoid forced selling during those critical early downturns. And that illiquidity risk, that's exactly why we must select assets based primarily on their downside risk, not just their overall volatility. This is really the core idea of postmodern portfolio theory, or PMPT. PMPT tells us that, look, all volatility isn't equal. We really only care about the risks that actively destroy our capital. That's the downside.
We use tools like the Sortino ratio to focus exclusively on losses. In one case study examining asset performance, time deposits actually yielded the highest return per unit of downside risk taken. Now, this highlights that stability and preservation, if they minimize negative volatility, are absolutely crucial in a retirement portfolio.
That's a compelling argument, I'll grant you that. Though I would perhaps reframe the PMT takeaway slightly. While preservation is absolutely key, optimizing for growth is necessary to ensure long-term solvency and fight that longevity risk we talked about. That same PMT case study you cited, it also demonstrated that the portfolio could be optimized, not just by prioritizing low downside assets like deposits, but critically by eliminating the bad assets, things like certain mutual funds and corporate bonds, which in the study carried massive downside risks, up to 16%. By eliminating those and focusing on, say, listed stocks with higher profitability and better liquidity characteristics, the optimized portfolio achieved a much higher return, 8.8% versus 6.8%, while lowering downside volatility dramatically. So this shows proactive optimization, not just passive preservation, is how institutional capital actually meets its long-term return targets.
And that proactive optimization, it often means looking for assets that inherently resist inflation and currency devaluation. Real assets, think infrastructure, real estate, commodities, they are naturally inflation buffering because their contractual structures often allow price increases to align with inflation. That's a key insight from firms like JP Morgan. This strategy reflects what institutional investors, the smart money, are doing to ensure long-term stability and inflation resistance that, frankly, highly valued public markets just cannot reliably provide right now.
Yeah, I fully support the inflation hedging argument. I mean, when we look at central banks globally accumulating hard assets, specifically gold, they are clearly doing so to guard against systemic currency devaluation and stability. Understanding the role of hard assets as portfolio ballast is essential, definitely. But we have to ensure we grasp the mechanics of actually incorporating them effectively.
This conversation really underscores a gap I see constantly. Most retirees with substantial IRAs, 100K, 500K, even millionaires, have never seriously explored how gold actually works in a retirement account. They hear about it, they see that central banks and major institutions are accumulating it, but they don't really understand the mechanics or whether it makes sense for their specific situation. If you're in that boat, there's actually a fantastic free resource. Augusta Precious Metals put together a comprehensive gold IRA guide that explains everything with no pressure whatsoever. You can download it from the link in our description. They've been around over 10 years, top rated for transparency, and they literally just focus on educating you. No high pressure sales tactics.
That's a good resource, yeah. What I appreciate about Augusta's approach is they really take the mystery out of it. The guide walks you through the 3 simple steps, how the rollover process actually works. Apparently, it's only about 15 minutes to get started, and most importantly, what the real costs and considerations are. Whether you ultimately decide gold is right for you or not, at least you'll understand what sophisticated investors and institutional capital already know about managing currency and inflation risk. Definitely check the description below for the free download. So, circling back to portfolio construction then. That sound inflation argument, it absolutely must be balanced against immediate liquidity management. The core protection strategy required to mitigate sequence risk, as Schwab often analyzes, emphasizes maintaining flexibility in spending and keeping a substantial portion of the portfolio in cash or short-term high-quality bonds.
This cash buffer is what funds early retirement expenses and crucially prevents forced selling during that critical first decade. So while hard asset diversification is, I think, a prudent strategy, and you see high net worth retirees typically allocating maybe 10 to 20% to these categories, that allocation must be manageable. It absolutely cannot compromise the core cash buffer needed for near-term income stability and that essential downside protection.
And I think we fundamentally disagree on the immediate priority here, and perhaps that's the central tension of retirement planning today. My position remains that relying solely on caution and perhaps excessive liquidity sacrifices necessary returns in an environment where public markets look significantly overvalued.
A forward-thinking strategy, in my view, requires aggressively diversifying away from these overvalued, correlated public assets and capturing opportunities in private markets and real assets to secure wealth longevity against inflation and, a 30-year timeline.
And I remain convinced that those first few years of retirement are simply the most financially precarious period that makes risk mitigation and maintaining near-term liquidity the absolute highest priority. Understanding the true downside volatility of your portfolio, assessed through metrics like those in PMPT, is essential before committing substantial capital to assets that are inherently illiquid, no matter the potential long-term payoff.
Ultimately, yes, both growth and protection matter immensely. But in this specific environment, I believe ignoring the long-term inefficiency and potential risk in public markets is itself a tremendous risk.
The critical takeaway for listeners, I think, regardless of which side they lean towards, is understanding why institutional capital, banks, wealth managers, central banks, are all moving toward hard asset protection and diversifying away from just relying on highly valued, correlated public markets.
Absolutely. And if you're curious about incorporating assets like gold into your IRA and exploring the mechanics of hard asset diversification for yourself, grab that free Augusta guide we mentioned. It's in the description. No obligations, just solid education.
Don't wait for the next major downturn to discover your portfolio wasn't as diversified or protected as you thought it needed to be.